All right, let's kick this off. We're going to start with your paper on index investing. The paper is literally titled "On Index Investing." But anyway, why are active managers important to indexing?
So active investors create the liquidity in the market. And by definition, they're the ones who end up taking the other side of passive investors trading, right? And active investors also collect information and try to buy up stocks that are underpriced and sell or short stocks that are overpriced. And in so doing, they move the prices to being more correct. And so active managers also set the prices at which index funds buy and sell.
Hmm.
And what are your model's predictions on how index investing affects information production about individual stocks?
So in the model, as passive investing goes up, it just pulls out a larger and larger chunk of the stock's market cap, which previously was available to active investors to hold and to trade. Since active investing is a zero-sum game, the stakes are now smaller for the active investors to compete over. As a result, active investors do less trading and they gather less information about individual stocks.
Hmm. So when you look at this, how does index inclusion affect the composition of active and passive investors in a given stock?
So that's an important question because the key research question that we're trying to address, the effects of, the rise of passive on financial markets, right? You need to separate the growth of index investing from all the other events that have happened over the same time period. That is, you want to avoid sort of spurious correlations.
Hmm.
So in the paper, we look at stocks that switch between the Russell 1000 and 2000 indices on a predetermined schedule. The Russell 1000 is the 1000 largest, that's the large cap index. And then the next stocks numbered 1001 through 3000 is the Russell 2000, the small cap index. Now, both of those indexes are cap weighted, market cap weighted. So if you go from the bottom, I should say, of the 1000 to the top of the 2000, that produces a jump of about 2% of the stock's market cap in passive fund holdings.
Wow. And how does index investing affect investor behavior and stock price dynamics?
We find that stocks that get a bump in this way to their passive holdings, they have higher trading activity, higher turnover relative to their float. They have higher short interest. They have higher volatility, their daily return volatility goes up, and they have higher correlation with the market as a whole.
So that was stocks with more index ownership. See those changes.
That's right. And, in some cases, it seems pretty clear and straightforward as to why, like the short interest component, many index funds make back a sizable, amount of their fees on or their revenue on loaning out the stocks that they hold for
Right.
short sellers to short, right? And so it makes sense that index funds relative to active funds would create a bump in the supply of shares to be shorted, for example.
Hmm.
The other
Yeah.
outcomes, things like correlation with the market, return volatility, it's a little harder to see, exactly what's causing what.
Hmm. So how do you measure information production, which is one of the things you guys are trying to figure out?
So we look at three measures. We look at Google searches for the stock's ticker, views of the firm's SEC filings. Think about their annual and quarterly reports, mostly on the SEC's Edgar website, and buy-side analyst reports about that stock.
That's really interesting. So it's literally like how much are people looking at this stock and how much are they writing about it? Hmm. Yeah, that's cool.
Mm-hmm. What are your empirical findings on how index investing affects information production?
For all three measures, when the stock gets a bump to their index fund holdings, we find that information production goes down.
Man, yeah, that's cool. And how does it affect price informativeness?
So the key question, of course, is really about, information production about a stock is not itself an important thing on a society-wide level. What matters is how accurate or informative or efficient the stock prices are, right?
Right.
And so we measure price efficiency three different ways as well. We look at variance ratios. The variance ratio is based on is this measure of random walkiness of the stock price, right? It goes back to, if the ratio of your volatility, your 1-day volatility to your 10-day volatility is about square root 10, then that says that your stock is relatively a random walk. And going back to Paul Samuelson, way back in the 1950s, a properly anticipated price should be a random walk is the statement about price efficiency, right? So we look at variance ratios, we look at this aggregate mispricing measure that Rob Stambaugh and co-authors constructed, and we look at post-earnings announcement drift, how quickly new information is incorporated into the stock price. And on all three measures, we actually find zero change across the board.
Wow. Random walkiness is a great term, by the way. I'm going to see if I can use that somehow. How is it that information production falls, but price informativeness is unaffected?
So that's the key puzzling or sort of interesting fact in the paper, right? Now, our model predicts this, but it is actually a very sort of simplified and stylized prediction. The intuition is that as the active pie shrinks, as a larger and larger proportion of the stock's float is taken out of the active market by the index fund investors, the active pie is shrinking. So as a result, as we said, the returns to gathering information shrink, but the level of noise trading by uninformed or less informed active traders also shrinks as well. And as a result, the ratio in that active section, a segment of noise trading to informed trading stays the same. And as a result, price informativeness, price efficiency is unchanged.
Wow.
So this is like, and I know you guys use a Grossman-Stiglitz framework, but this is like the Grossman-Stiglitz paradox happening in real life.
Exactly. So it's a very, like I said, it's a very stylized model. It abstracts from like a lot of things, right? But I think, Grossman-Stiglitz is a classic for a reason. It captures some very deep intuitions that we like.
Yeah, super cool. So what's your main conclusion on how index investing is affecting price efficiency?
So I could say a lot of things here, but I would say, first of all, that the model is very simple and stylized, but it captures some very kind of reasonable intuitions on two sides, okay? The first side is index funds have grown enormously, right? Passive investing has just grown by leaps and bounds. But index funds have a very strong incentive to minimize their effects on the stocks that they hold. In other words, to minimize market impact, right? Vanguard, State Street, and BlackRock have a ton of really, really smart, hardworking people who work there, and that's their job, is to like, how can we minimize market impact, right? On the other hand, at the same time, active investors always have a strong incentive to search out mispricing or information and trade on it. That's what they do. And furthermore, I could say, like, a former PhD student of mine, Da Wang, who now is a professor at Northeastern, his PhD thesis actually explored that as passive investing rises, which active managers drop out. And it turns out that it's disproportionately the worst performers, right? Those with the worst performance and the worst returns among active managers who see the most outflows and are most likely to close up shop. So kind of on both sides of the rise of passive, it makes sense that market quality and efficiency of financial markets should be pretty robust to the rise of passive investing. There are very strong forces on both sides that are pushing us back to equilibrium.
So do you have a thought on at what point it becomes a problem? At what point passive becomes a problem in terms of price efficiency?
I mean, so again, in our simplified stylized model, you go all the way up to 0.9999 of the market is passive, and there's literally like one guy with $1, and that guy sets the prices, and things work out fine. I don't think we will ever get to that point.
Right.
But, I will also say, I don't think we'll ever get to the point of, it's going to tail off at some point. The strongest comment on this I could make is that people love to trade actively, right? And in fact, the main use of like ETFs, for example, which are these giant passive vehicles, is for people to trade baskets of stocks in an active way.
Right.
Right? People are now like day trading ETFs, which is
Yeah.
such a bizarre, counterintuitive thing to be doing in some sense, right? Um,
Yeah.
and so I don't think we're, I think the market can evolve a lot more, and you will still see plenty of active trading, plenty of information gathering, and I think prices will still be pretty efficient for the reasons I
Yeah.
said earlier.